Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. This week we examine the drivers behind strong performance of commodities and discuss the outlook. Commodities have outperformed equities only for the second time this decade in 2021. Even on a year-to-date basis, this outperformance continued. While global equity benchmarks are down circa 5% so far this year, broader commodity benchmarks rose more than 10%. Looking at individual commodity groups, energy block rose circa 24%, livestock prices increased 11%, agricultural commodities climbed 8%, and industrial metal prices grew 5%. However, precious metals were an exception and lost circa 2% of their value year to date. Behind this recent outperformance of commodities relative to financial asset classes are the so-called oddities, or one can say peculiarities of this real asset group. Purely from an investment perspective, there are primarily three reasons to have portfolio exposure to commodities. First is inflation. Given the ability of commodities to maintain their value in real terms, they tend to be attractive at times when inflation is rising. When broader inflation is rising, cost of producing commodities rises too, and this directly feeds into higher commodity prices. Rising inflation of recent months has certainly benefited commodities from this angle. So any moderation in inflation from current levels is likely to put some downward pressure on commodity prices. Second reason is rising interest rates. Unlike financial assets, commodities are not valued based on discounted future cash flows, and therefore, rising real rates do not materially influence the present value of commodities. Especially when the supply, demand, and inventory dynamics are all supportive, prices of commodities can continue to go up even in a rising real rate environment. This dynamic might remain supportive of commodities in the near term, but we think much of this has played out already. Third reason to consider portfolio exposure to commodities is their ability to provide diversification. Here, while commodities are considered a distinct group of assets, they tend to be very volatile and display higher beta to risk at times. This makes them slightly higher risk proposition and may not be suitable for all portfolios. Especially after a massive rise in prices in recent months, should some of the supply-demand imbalances start to normalize, prices could experience sharp reversals. One should never forget the fact that commodity block is really a diversified set of things, ranging from livestock to iron ore to gold to crude oil. Now, I would like to focus on two individual commodities, gold and oil, on which we keep receiving questions. Let's start with gold. We hold an overweight position in gold, which in our view remains a classic hedge against potential inflation and geopolitical risks. Historically, gold prices exhibited a strong negative correlation with the US real bond yields. Yet, over the past 18 months or so, despite the real bond yields remaining near record lows, gold prices slumped. This deviation from the historical trend can be explained by the rise of cryptocurrencies as a potential alternative to gold. Jury is still out on whether cryptocurrencies can eventually replace gold in portfolios. In the near term though, we continue to see gold retaining its attraction as a strong hedge against risks that are negative for risk assets. For gold, higher demand for coin, bar, and jewelry may be the offset for weakness in demand for ETFs. Central bank demand has revived in 2021. After a record high buying in 2019, central banks slowed down their purchases of gold in 2020. 2021, however, saw central bank gold buying pick up quite strongly. Higher gold prices could in turn help the gold miner equities, which have underperformed broader global equity benchmarks in 2021. Turning to energy, the prices of oil and other energy commodities are likely to stay elevated as the market begins to balance into a new supply-demand regime. Recent weeks also saw some significant geopolitical risk premia get embedded into higher energy prices. Given oil prices of more than $90 a barrel at the time of recording this podcast, should political risk start to abate, we think there is potential for some downside in the near term. Of course, some upside beyond that for the following 12 months. On the fossil fuels, the prices are likely to stay elevated in the near term as the renewables are not yet widely available to meet the energy demand at the time when the additional fossil fuel supplies are likely to remain constrained. However, higher fossil fuel prices in the near term should in turn accelerate the migration to renewables over the medium to long term. Against this backdrop, the outperformance of oil and gas equities relative to clean energy segments during 2021 was already noteworthy. Further, the gold to oil ratio, which is a widely tracked metric, is now close to the 50-year mean, indicating a neutral position of gold against oil. In a nutshell, commodities have outperformed strongly in recent months. While there are reasons for investors to consider some exposure, commodities may not be suitable for all portfolios. Within the commodity block, which is a really diversified set of things, we stay overweight gold and maintain a constructive view on oil prices over the next 12 months. Thank you for listening to this podcast. We hope you found it useful. In case you would like to get more information on what was discussed on this podcast and to get more detailed views on commodities, please reach out to your contact at ADCB. You can also log on to our website www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I'll be back next week with more global investment insights.